Have you ever wondered why banks pay you to save money and charge you when you borrow it? Why mortgage payments change when central banks make policy moves? Why your credit card balance feels like it grows overnight? The one thread that ties all of this together is the interest rate. Today, we're going to demystify interest rates. We'll explain what they are, how they're set, why they rise and fall, and most importantly, how they affect your wallet. By the end of this video, you'll understand how interest rates shape the economy and how to make smarter financial decisions because of it. Number 1, what is an interest rate? At the simplest level, an interest rate is the price of money. If you borrow money, the interest rate is what you pay to use it. If you save money, the interest rate is what you earn for letting someone else use it. It's a percentage, quoted on an annual basis, that tells you how much extra you will pay or receive. Imagine lending a friend $100. If they agree to pay you $5 a year in return, that's a 5% interest rate. On loans, this percentage becomes the cost that borrowers pay. On savings, it becomes the reward that savers receive. Number 2, simple versus compound interest. There are two basic ways interest can be calculated. Simple interest is direct. You pay interest on the original amount only. Compound interest is the powerful one. With compound interest, interest is paid on interest. Year 1 you earn interest on your principal. Year 2 you earn interest on the principal plus the interest from year 1. That compounding effect accelerates growth over time. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether that's true or not, the math doesn't lie. Number 3, who influences interest rates? Interest rates are heavily influenced by central banks. In the US, that's the Federal Reserve. In Australia, it's the Reserve Bank. These institutions set policy rates, often called the cash rate or the federal funds rate. Banks and lenders then use that policy rate as a benchmark to price mortgages, loans, and other financial products. When central banks raise their policy rate, borrowing costs rise across the economy. Mortgages and business loans become more expensive. When they cut rates, borrowing becomes cheaper and spending tends to increase. Central bankers adjust rates to balance two major economic goals: controlling inflation and supporting employment. Number 4, why do interest rates exist? Interest rates exist because money has a time value. $1 today is worth more than $1 tomorrow because you can invest it, spend it, or earn from it. Lenders demand compensation for postponing their own spending and for taking on the risk that the borrower might not repay. Interest rates compensate for 3 things: time, risk, and inflation. Number 5, how interest rates affect everyday life. Interest rates affect almost everything you care about financially. Home loans, when rates rise, your mortgage payments often go up. Car loans become more expensive. Credit card balances grow faster if you don't pay them off. At the same time, savers may earn more on deposit accounts or term deposits if rates climb. Interest rates also shape investment returns. When rates are low, investors often look for higher returns in stocks or property. When rates are high, bonds and savings accounts become more appealing. So interest rates influence where money flows across the entire financial system. Number 6, fixed versus variable rates. Some loans have fixed interest rates. Fixed rates stay the same for a set period, giving borrowers predictability. Other loans are variable, moving up and down with benchmark rates. Variable rates can be cheaper when central banks cut rates, but they introduce uncertainty. Choosing between fixed and variable depends on your tolerance for risk and your financial plan. Number 7, inflation and real interest rates. Understanding the difference between nominal and real rates is crucial. Nominal rates are the rates you see advertised. Real rates adjust for inflation. If your savings account pays 4%, but inflation is 3%, your real return is roughly 1%. Inflation erodes purchasing power, so savers need returns above inflation to truly grow wealth. Number 8, how markets set rates beyond policy. While central banks set policy, markets set many interest rates. The yield on government bonds, mortgage rates, and corporate borrowing costs are determined by demand and supply. Investors price in expectations for future inflation, central bank moves, and economic growth. If investors believe inflation will rise, they demand higher yields to compensate. That expectation feeds back into borrowing costs across the economy. Number 9. The role of credit risk and ratings. Not all borrowers are equal. Governments like the US or Australia are considered low risk, so their bonds yield relatively low interest. Companies with weaker balance sheets must offer higher interest to attract lenders. Credit rating agencies provide assessments, and those ratings impact the interest rates companies pay. Number 10. Interest rates and the housing market. Interest rates are a major driver of housing affordability. Low rates tend to boost house prices because buyers can borrow more cheaply. When rates rise, mortgage payments increase and demand often cools. That's why central bank decisions have immediate ripple effects in property markets. Number 11. Strategies for savers and borrowers. If you're a saver, shop around for deposit accounts that pay competitive rates. Consider moving some cash into term deposits or high-yield accounts when rates are attractive. If you're a borrower, lock in a fixed rate if you value stability, or choose a variable rate if you expect cuts and can handle volatility. Always stress test your budget for higher rates and keep an emergency buffer. Number 12. Interest rates and business decisions. Businesses use interest rates to decide on investments. High borrowing costs can delay expansion projects. Low rates make capital-intensive investments more attractive. That is why interest rates influence hiring, capital spending, and even innovation cycles. Number 13. Global interplay of rates. In our global economy, interest rates also reflect international capital flows. A country offering higher rates may attract foreign investors seeking yield, which can strengthen that country's currency. Conversely, low rates can push capital abroad. Central banks monitor each other closely because a major move in one country can ripple across markets worldwide. Number 14. Historical perspective and cycles. Interest rates move in long cycles. After the high inflation of the 1970s and 1980s, many developed economies experienced decades of falling interest rates. More recently, rates hit historic lows following the 2008 financial crisis and again during the pandemic. That history shows that rates can stay low for an extended period or rise rapidly when inflation returns. Number 15. Common myths about interest rates. Myth 1. Low rates are always good. Not true. Low rates help borrowers, but savers earn less, and low rates can encourage excessive risk-taking. Myth 2. High rates only hurt borrowers. High rates can help savers, and they can be necessary to cool runaway inflation. Myth 3. You can time rate moves perfectly. Central bank decisions depend on complex data. Even experts can be surprised. Number 16. Practical takeaways. Interest rates matter because they determine borrowing costs and returns on savings. They influence almost every financial decision you make. Monitor central bank statements, track inflation trends, and understand how rate moves affect your specific loans and investments. When rates change, revise your plans and stress test different scenarios. Number 17. Questions to ask your financial advisor. Should I fix my mortgage or go variable? How much of my portfolio should be in bonds versus equities when rates rise? Would a term deposit be better than leaving cash in a low-interest account? A good advisor will run numbers specific to your situation and help you choose the right approach. Number 18. How to benefit from rate cycles. Think in scenarios. When rates fall, locking low fixed mortgages or refinancing can cut payments. When rates rise, focus on paying down high-interest debt and use short-term deposits to capture better yields. Keep some cash ready for opportunities and avoid emotional moves during volatility. Final thought. Interest rates change and affect most money decisions. Learn the signals, plan for multiple outcomes, and you'll be better prepared. If this helped, subscribe to Finance Talkin' and ask one question on interest rates today.